have no yield, lost opportunity cost, yada, yada. What if yield on UST tips, I-bonds, stock market versus inflation? If you believe CPI, which one actually gives positive return minus depreciation?
It's gold and silver.
That's it.
I mean, it's double the 10-year treasury, and over the last 25 years, it's 10x'd it over the last few, and the yield is irrelevant when you realize that the yield that we are being the yield that you get on a treasury right now, what, 4%? But inflation is, by their own standard, is barely below that, and we know it's much higher. And that gold has averaged 9.9% per year for the last 25 years. I don't think you need a yield on gold when you look at real negative return on bonds right now. When you factor in against inflation and money creation, I'd take my chances with gold and silver. And they're going to lie about inflation. They're going to cap yields, and the market's going to understand that. And they're going to demand higher yields. They're going to be capped. You're going to see inflation, because that money has to be created to keep those rates down, to buy those treasuries. It's a vicious cycle. So go back and look at any asset that you own for the last 25 years and measure it in ounces of gold, and you'll see they've depreciated tremendously. Gold has outperformed virtually anything. So you don't have to have yield in this environment. And the funny thing is we're in a period of time where if yields go up too high, it blows everything up. The stock market, the bond market, the real estate market, the pension market, the banks, the insurance companies, they all blow up if rates go too high, as do our funding obligations. So in essence, they're going to continue to inflate, lie about the levels of inflation, cap the yields, and gold and silver should benefit most from that, regardless of a non-interest yielding asset.
So just in response to the question that we just answered, we have another comment that Joshua Shearer says, I've been looking around online for junk silver under spot, and it seems like all the silver providers are selling it at spot now. Nothing is under spot anymore. What happened? That's it. That's the point. It just like that, it happens. Well, not just spot price moves, but premiums move at the same time also.
You know, what's very interesting about what we've seen is that the central banks bought more the first quarter than at any time in history. They lied about it. They said they only bought 16 tons. The World Gold Council flagged it at 244 tons, just a 15 times undershoot, misstatement.
A 15 times gap between reported central bank gold buying and the World Gold Council's own estimates deserves more attention than yet another inflation headline. Schectman's argument is that real returns, not nominal yields, determine whether bonds actually preserve purchasing power. If governments have to keep suppressing yields while inflation stays elevated, savers end up absorbing that hidden cost through a weaker currency instead. That's also why disappearing silver premiums below spot price matter. They're part of the same story.
As the public sold into this rally into January. The big money smashed the price down by levering up or raising up margin rates and rebalancing ETFs and creating a windfall of selling, squeezed out all of the leverage and the speculators, and bought more than at any time in history. China importing more silver than at any time in history the first quarter. Central banks buying more than any time in history in the first quarter as the price was destroyed. And that, you look at the amount they've continued to purchase, it's increased every month since then. If I had my glasses on, I would look, but the last few months here, I have some right here, actually. Here, let me tell you real quick. Here's the numbers. So they bought 40,000 ounces of gold in January, 30,000 in February, 160,000 in March, 260,000 in April, 320,000 in May, 80,000 in June, and in July, 640,000 ounces.
Damn.
So as the price has been getting hit and doing nothing, China,
all up.
Tether, Poland, and all the central banks have been buying. And so again, the big money moves opposite the herd, and that's what I take away from all of this. The price has just been misdirecting the masses. The big money's been using it as a subsidy, and that's the truth. And that's you can't argue that.
I heard a very good presentation on misdirection.
You did?
I did.
Where?
Boca Resort.
Oh yeah, thank you. I
Yeah.
appreciate that.
Good-
but it's
good
true.
presentation.
Misdirection
It
is everywhere, dude. It is.
If there are almost 90,000 contracts up on the Comex in September, will they drive the price down again to protect the shorts? How low will it go? This manipulation sucks.
Who knows? They have an amazing way of working that open interest down to manageable levels as it gets closer to expiration, and maybe through cash incentivizing settlement.
Yep.
That is one of these days. That's always the theory, but it's hard to even envision that when you realize the banks own the exchanges. Unless maybe they caught the traders on the, they had all the commercials long, and they caught some traders short, or I don't know. Look, all manipulations end bad, and over time, the physical demand coming from a good portion of the world that is now educated, motivated, sophisticated, coordinated, wealthy, and building settlement systems in other currencies for same-day settlement and gaining traction and legitimacy into a network of massive vaulting network and exchanges, so far all of them in dollars, but not Hong Kong. You look at United Arab Emirates, you look at Singapore, their same-day settlement.
Nearly 90,000 September Comex contracts sounds like heavy pressure on the surface, but open interest alone can't tell you who's actually trapped in a position. Schectman's argument is that the more meaningful shift is speculative leverage losing its grip as physical buyers build out alternative settlement networks. If paper positioning keeps losing influence while genuine metal demand holds steady, repeated attempts to hold prices down become harder to pull off. That distinction matters because investors risk confusing engineered volatility with real weakness.
In dollars, but the same-day settlement and the ability to settle in digital yuan or in yuan is I think becoming very appealing to a good portion of the world that doesn't trust the way commodities have been priced in the West for a long time. And so this isn't about it happening, this blow up all at once, but every single exchange, every single settlement exchange, every single vaulting system, all the payment rails, they're being set up to challenge the commodity complex, and BRICS just reaffirmed their grain exchange, that they're gonna run their grain exchange. They just came out and said, yes, this is going to be one of the big topics in their next meeting in India. And I talk about the statement that one of Putin's advisors who's helping with this said, we consume as much or more grain as they do in the West. We can't control the pricing. That's done in Chicago on the Board of Trade, but this will change things with the development of this new exchange. Well, the same thing is true. They understand that. The same thing is true with metals. They also talk about building, again, a new BRICS metals exchange, which, again, all of these exchanges, China just signed a deal with Africa's largest bank to settle in yuan, which is convertible into gold. All of these things are happening and challenging over time. So we'll reach a point where you got to be out of your mind and be naked short large amounts on Comex when the ability to shift things to Hong Kong with a contract and stand for delivery at a different price will put you out of business. So I don't know, maybe we're beginning slowly to see an era of truer price discovery.
A bigger threat to Western commodity pricing might be the emergence of markets that simply don't need Western sign-off at all. Schectman points to China, Singapore, Hong Kong, and the BRICS bloc building out their own rails for settlement, vaulting, and price discovery. The overlooked issue isn't whether one exchange suddenly dethrones Comex overnight, it's whether liquidity gradually splinters across competing systems instead. For investors, that could make familiar benchmarks increasingly poor proxies for actual physical scarcity.
Not today, but we're getting closer to.
Well, today was again, it was a little bit, I think, of maybe the start of something that could be something. You mentioned, of course, China. Asia in general is very rapidly expanding their infrastructure, just in banking, in storage, and settlement. DBS in Singapore now allows for fractional gold backed by as little as 1 gram, which is pretty nuts. And then, as we talked about, I think you talked about quite a bit, was HSBC plan on expanding their storage capacities. for, I think it was for the Hong Kong vault for what, was it 200 tons?
I don't know. I know
It's
that
a number.
China is sending a lot of gold to Hong Kong. They're trying to make it a real legitimate hub for the global South and the Middle East.
Yeah, they supposedly want to add 2,000 tons of gold capacity storage-wise over the next 3 years. That's a big number. That's a big
huge
number. Yeah. Asian gold ETFs are seeing record demand. So there's so much going on there that it has to